Rachel Siegel from the Washington Post. Thanks very much for taking my question. I'm wondering if you can speak specifically about what indicators you're seeing that suggest the pace of improvement has moderated, including in the labor market, and how correlated those indicators are to the recent rise in COVID cases that we've seen going into flu season. Thank you.
Sure. So, of course, let's start with February. In February, we had an economy that was performing well. Then the pandemic hit, and we had a record decline in activity in March and April. And then we had a record bounce back in May and June. And so, as I think would have been expected and was expected, the pace of improvement from May and June has now moderated. So it's not unexpected. And I think if you look at just about anything, for example, the payroll readings, the payroll job gains in May and June were just outsized. And they're certainly still very large, but the pace of improvement has moderated. That's the case for all different measures in the labor force, in the labor market rather. Another would be claims. Just about all the data showed a big bounce back, but then, as you would expect, when you sort of had a lot of people go back to work at once, the pace will moderate. Same thing with economic activity. Most forecasts call for, still a significant growth in the fourth quarter, but not at the 33% annualized pace that we had in the third quarter. So in a sense, that would be as expected. We have been concerned that the downside risks, though, are prevalent now, which are really the risk of the further spread of the disease, and also the risk that households will run through the savings they've managed to accumulate on their balance sheet, and that could weigh on activity. But what we see up to the present really is continued growth, continued expansion, but at a gradually moderating pace.
Shepard Smith here. Thanks for watching CNBC on YouTube.